The year was 2002. The world was still grappling with the aftermath of the dot-com bubble burst, a financial catastrophe that had left investors wary and markets volatile. The dot-com bubble had just burst. Investors were already reeling from the shockwaves that had rippled through the financial world. Many had lost fortunes, and the trust in the tech sector was at an all-time low. Then news broke of a massive accounting fraud. It was a revelation that would further shake the already fragile confidence of investors and the public alike. This time it wasn't some fly-by-night startup. It wasn't a small player trying to make a quick buck in the chaotic tech landscape. It was WorldCom, a telecommunications giant, a company that had been a cornerstone of the industry, trusted by millions and seen as a beacon of innovation and growth. The company had falsely inflated its assets by a staggering $11 billion. This wasn't a minor error or a small oversight. It was a deliberate act of deception on a massive scale. It was one of the largest accounting scandals in history. The magnitude of the fraud was almost incomprehensible, dwarfing previous scandals and setting a new, grim benchmark for corporate malfeasance. The WorldCom scandal sent shockwaves through Wall Street and beyond. The immediate reaction was one of disbelief and panic as traders and investors scrambled to understand the full implications of the fraud. It shattered investor confidence and exposed the dark side of corporate greed. The scandal revealed how far some companies would go to present a facade of success, regardless of the ethical and legal boundaries they crossed. This is the story of how a company built on ambition and innovation crumbled under the weight of its own deceit. WorldCom had once been a symbol of the new economy, a leader in the telecommunications revolution. It's a story of unchecked ambition, corporate arrogance, and the devastating consequences of financial fraud. The executives at WorldCom were driven by a relentless pursuit of growth and profit, often at the expense of ethical considerations. This scandal wasn't just about numbers on a balance sheet. It was about the real-world impact of those numbers, the lives affected by the decisions made in corporate boardrooms. It was about real people, employees who had dedicated their careers to the company, believing in its mission and its future, employees who lost their jobs and life savings. The human cost of the scandal was immense, with thousands of workers suddenly finding themselves unemployed and financially devastated. Investors whose trust was betrayed. Many had invested their hard-earned money into WorldCom, believing in its potential and its promises, only to see their investments evaporate, and a system that allowed such massive fraud to occur. The scandal highlighted significant flaws in the regulatory framework, raising questions about oversight and accountability. The WorldCom story serves as a cautionary tale. It is a stark reminder of the dangers of unchecked corporate power and the importance of ethical leadership. It reminds us that ethical lapses can have far-reaching consequences. The ripple effects of the WorldCom scandal were felt across the financial world, leading to a re-evaluation of corporate governance practices. It underscores the importance of transparency and accountability in business. Companies must be held to high standards, and their actions must be scrutinized to prevent such abuses of power. And it highlights the need for robust regulations to protect investors and the integrity of the financial markets. The aftermath of the WorldCom scandal saw significant changes in financial regulations, aimed at preventing future frauds and restoring trust in the system. The story of WorldCom began in 1983, in the small town of Clinton, Mississippi. It was a time when the telecommunications industry was dominated by giants like AT&T, and the idea of a small company making a significant impact seemed almost impossible. Bernie Ebbers, a former basketball coach with a larger-than-life personality, and a group of investors founded LDDS, Long Distance Discount Service, in Clinton, Mississippi. They had a vision to revolutionize the telecommunications industry by offering long-distance services at a fraction of the cost of the established players. It was a small, ambitious company with a simple goal: to undercut AT&T's long-distance rates. This was a bold move considering AT&T's stronghold on the market, but LDDS was determined to carve out its own niche. Through a series of aggressive acquisitions, LDDS grew rapidly. The company was relentless in its pursuit of growth, acquiring smaller competitors and expanding its reach across the United States. Each acquisition brought new customers, new technologies, and new opportunities. Ebers was a charismatic and ruthless leader. His ability to inspire and motivate his team was matched only by his determination to succeed at any cost. He was known for his larger-than-life presence and his unwavering confidence in the company's future. He had a knack for deal-making. Ebers could see opportunities where others saw obstacles, and he was willing to take bold steps to seize those opportunities. His deal-making skills were instrumental in LDDS's rapid growth. He wasn't afraid to take risks. In fact, he thrived on them. Ebers believed that taking calculated risks was essential for the company's success, and he encouraged his team to embrace this mindset. By the mid-1990s, LDDS had morphed into WorldCom, a telecommunications powerhouse. The company's transformation was nothing short of remarkable, and it was now a major player in the industry. WorldCom's growth was fueled by the booming telecom industry. The demand for telecommunications services was skyrocketing, and WorldCom was perfectly positioned to capitalize on this trend. The internet was exploding in popularity. People were beginning to realize the potential of this new technology, and the demand for internet services was growing at an unprecedented rate. Demand for bandwidth and data services was skyrocketing. Companies and individuals alike were clamoring for faster, more reliable internet connections, and WorldCom was ready to meet this demand. WorldCom was perfectly positioned to capitalize on this growth. The company's extensive network and innovative services made it a leader in the industry, and its future looked incredibly bright. It acquired MCI Communications in 1998 for $37 billion. This was a game-changing move that catapulted WorldCom to the forefront of the telecommunications industry. It was one of the largest corporate mergers in history at the time. WorldCom was riding high. Its stock price soared, and investors were thrilled with the company's performance. Ebers was hailed as a visionary leader. He was celebrated in the media and admired by his peers for his bold leadership and innovative strategies. But beneath the surface, cracks were beginning to appear. The company's rapid growth had come at a cost, and there were signs that all was not well within WorldCom. The company's aggressive growth had come at a cost. WorldCom had taken on a massive amount of debt to finance its acquisitions and expansion efforts. WorldCom had taken on a massive amount of debt. The pressure to maintain its growth trajectory was immense, and the company's financial health was becoming increasingly precarious. Its accounting practices were becoming increasingly complex and opaque. As the company grew, so did the complexity of its financial operations, making it difficult for outsiders to get a clear picture of its true financial state. As the telecom boom began to fizzle in the late 1990s, WorldCom faced a problem. The company, once a darling of Wall Street, was now grappling with a significant slowdown in its revenue growth. The rapid expansion that had characterized the telecom industry was coming to an end, and WorldCom was feeling the pressure. Its revenue growth was slowing. The executives at WorldCom were desperate to find a solution. They knew that without continued growth, their stock price would plummet, and they would lose the confidence of investors and analysts alike. To maintain its high-flying stock price and meet Wall Street's expectations, WorldCom's executives resorted to accounting fraud. They were determined to keep the illusion of success alive, no matter the cost. Led by CFO Scott Sullivan, they began manipulating the company's financial statements. Sullivan, a key figure in the company, orchestrated the fraudulent activities with precision and cunning. Their primary method was deceptively simple. They capitalized on expenses. This meant that instead of recording everyday operating costs as expenses, they classified them as capital expenditures. Instead of expensing ordinary operating costs, they classified them as capital expenditures. This accounting trick allowed them to spread these costs over several years, making the company appear more profitable in the short term. This made the company appear more profitable than it actually was. Investors and analysts were none the wiser, and the stock price remained artificially inflated. Imagine buying a cup of coffee every morning and putting it on your mortgage. It might seem like a clever way to manage your finances, but in reality, it's a recipe for disaster. It might look good on paper in the short term, but it's not a sustainable financial strategy. Eventually, the truth will come out, and the consequences will be severe. WorldCom's fraudulent accounting practices went undetected for years. The company continued to report impressive profits and its stock price remained high. The company's auditor, Arthur Andersen, failed to raise any red flags. Despite their responsibility to ensure the accuracy of WorldCom's financial statements, they turned a blind eye to the fraud. Andersen, one of the big five accounting firms at the time, was more concerned with keeping its client happy than with upholding its fiduciary duty to investors. This lack of oversight allowed the deception to continue unchecked. This elaborate scheme allowed WorldCom to artificially inflate its assets by $11 billion. The company's financial statements were a work of fiction, designed to deceive investors and analysts. The company's reported profits were a sham. The executives celebrated their apparent success, but it was all based on lies. It was all built on a foundation of lies. Eventually, the truth came out and the entire facade came crashing down. The $11 billion deception was exposed and WorldCom's legacy was forever tarnished. By 2002, the walls were closing in on WorldCom. The Securities and Exchange Commission, the SEC, had begun investigating the company's accounting practices. Internal auditors, led by Cynthia Cooper, were also starting to ask uncomfortable questions. Cooper's team worked tirelessly, often late into the night, poring over thousands of documents. They faced resistance from superiors, but they persisted. They knew something was wrong, and they were determined to get to the bottom of it. Their persistence paid off. In June 2002, Cooper's team uncovered $3.8 billion in fraudulent accounting entries. It was just the tip of the iceberg. Further investigation revealed the true extent of the fraud, a staggering $11 billion. On June 25, 2002, WorldCom announced that it had inflated its assets by $11 billion. The news sent shockwaves through the financial markets. WorldCom's stock price plummeted. The company was forced to file for bankruptcy. It was the largest bankruptcy filing in US history at the time.